What's up, guys? Welcome back to the channel where we discuss professional development, the CPA lifestyle, and everything in between. If that sounds awesome to you, make sure to hit that subscribe button below, and welcome to the channel. I am officially starting a new series on the channel where I'm going to teach you guys the fundamentals of accounting. This series will teach you the basic building blocks of accounting and why it's so important. Today, we're going to go over the basic accounting equation. This small accounting equation we're going to go over today is going to carry you through any single transaction you go through. Yes, every single transaction. Every single accounting transaction that you encounter in your career or at school will need to follow this law. The accounting equation is kind of like life. It always needs to balance. The law of the accounting equation states that assets equal liabilities plus equity. Again, I will repeat this. Engrave this in your brain forever. Assets equal liabilities plus equity. Again, repeat with me. Assets equal liabilities plus equity. Now, let's define assets. Assets are simply defined as resources or stuff that the company owns. Examples of assets can include things such as cash, accounts receivable, inventory, equipment, and investments. Liabilities are simply defined as a company's financial obligations, or it can be money the business owes to its employees, vendors, or banks in the form of loans. It's essentially money the business owes to creditors. Equity can be a very complex, tricky subject to grasp, but for now, you can think about equity as an owner's interest in a company after all the liabilities have been deducted. Or you can also think about equity as profits of a company held for some future use. Now, let's illustrate the accounting equation in real life. Let's say we start a really cool t-shirt company called CPA Swag. To fund the operations of CPA Swag, we initially deposit $1,000 in the company's bank account. The accounting equation would be impacted as follows. Cash would increase by $1,000 because we put $1,000 in the company's bank account. Equity would also increase by $1,000 because this is an ownership in the company after deducting all liabilities, and since we have no liabilities, $1,000 goes to equity, or it's essentially the profits in the company as of now held for future use. With this example, the accounting equation is in balance. Assets equal liabilities plus equity. We now want to buy t-shirts for the company, which is going to be our inventory, which we're going to sell to potential customers that we are going to purchase from a supplier. We buy the inventory on credit from a supplier for $500. As inventory is a resource that we own, we will increase inventory or assets by $500 for total assets of $1,500. We will also increase liabilities via accounts payable by $500 as we purchase the inventory on credit. We also have the initial $1,000 capital injection, which is an owner's equity, for total liabilities and equity of $1,500. With this, assets equal liabilities plus equity. The accounting equation is in balance. Let's say we did a great job marketing the CPA Swag company and we sold all of the inventory we had on hand, all of the t-shirts, for $800. We will now need to record the sale of inventory that we have on hand. We will first reduce all of the inventory we have on hand by $500. As we sold all the inventory we had on credit to customers, we will also increase assets via accounts receivable by $800. The difference between our sales price, $800, and the cost of inventory, $500, leaves us with $300 of gross profit, which ends up in equity. Let's now look at our accounting equation. We have cash of $1,000 and accounts receivable of $800 for total assets of $1,800. On the other side of the accounting equation, we have liabilities of $500 via accounts payable. We have $1,000 of paid in capital, which was the initial capital injection in the business, and also $300 gross profit in retained earnings from the initial sale we made. That brings our total liabilities and equity to $1,800. With this, assets equal liabilities plus equity. The accounting equation is in balance. We now want to take a different approach with the business, and we want to start making our own t-shirts internally. In order to make this business change, we go buy a printing machine for the business for $300 with cash. This transaction is slightly different from the ones we went through already because these are both two assets which we own, stuff we own that are being impacted. Our cash will now go down by $300 because we paid for the equipment with cash, but our equipment will go up by $300 because it's something that we own, it's a resource we own for future use. At the end of these four transactions, our balance sheet, which is simply the accounting equation for a company at a point in time, will be as follows. We have cash of $700, accounts receivable of $800, and equipment for $300, which give us total assets of $1,800. On the other side of the accounting equation, we have accounts payable for $500, paid in capital of $1,000 from the initial funding of the business, and $300 in retained earnings from the profit made on the first sale. That gives us total liabilities and equity of $1,800. The accounting equation is in balance. Assets equal liabilities plus equity. The accounting equation is the single most important law and rule in accounting. Remember this from this video. Accounting is like life. It always has to balance. I don't want any of you to just memorize this accounting equation. I want you to conceptually understand how and why it works, because this accounting equation will carry you through any single transaction you encounter. That's going to be it for the video today. If you found some value in the video, please make sure to hit the like button below. Also, please make sure to share this video with any of your accounting friends. Follow me on any social media platform you use. And until next time, work hard, dress well, peace.